So we will see the question number 8, that is debentures. Debentures are corporate debt instruments, represent borrowed capital for companies, secured or unsecured financial obligations issued with fixed interest rates. Companies use debentures for finances. Investors earn periodic interest payments. Legal contracts govern debenture terms. Debentures are transferable financial instruments, rank above equity during liquidation, offer lowers returns than equities. Debenture holders have no voting rights. Secured debentures backed by assets. Unsecured debentures rely on issuer credibility. Convertible debentures turn into equity. Non convertible debentures remain as debt. Redeemable debentures returned after maturity. Perpetual debentures lack maturity dates. Debentures regulated under corporate laws important for diversified financial portfolios. Investors prefer debentures for stability. Types of debentures: secured debentures backed by companies' fixed assets, provide safety during liquidation events. Priority over unsecured debt instruments. Interest rates lower due to security collateral, reduces investment risk significantly. Issued under company specific trust deeds. Debenture holders entitled to specific assets common among infrastructure development projects, protects creditors from financial losses, favorable for risk averse investors globally. Secured debentures increase market trust. Transparent agreements ensure compliance standards. Financial institutions prefer secured instruments. Mandatory registration with appropriate authorities strengthen creditworthiness for issuing companies. Reduced speculative nature of investments. Example: real estate backed bond instruments. Security ensures guaranteed investor returns. Collateral includes land, machinery, equipment widely accepted for long term financing. Unsecured debentures, no collateral backing these instruments. Higher risk compared to secured counterparts. Higher interest rates compensate investors. Relies solely on issuers' creditworthiness. Suitable for financially strong companies. Carry subordinate priority during liquidation. Popular among established market players. No asset-based repayment guaranteed offered, often issued for short-term funding. Regulated under applicable corporate legislations, include governance for default protection measures common in high-yield bond categories. Example: debentures by renowned conglomerates. Investors assess issuers' financial stability. Lack of collateral issues increases speculative potential. Attracts high risk, high return investors. Risk mitigated via diversified strategies. Offers flexibility in issuing processes. Preferred in booming economic environments. Strengthens corporate fundraising capabilities effectively. Convertible debentures convert into equity after tenure. Offer fixed interest before conversion. Entice investors with dual benefits. Attractive during bullish market conditions. Provide stakeholding without direct investment. Issuers reduce debt post conversion. Dilutes existing shareholders' ownership percentages. Valuation depend, dependent on market equity prices. Favored by startup companies globally. Combine safety and equity appreciation potential. Example: Tesla convertible bonds issuances provides upward potential for returns. Conversion terms predetermined during issuance. Equity based taxation benefits post conversion. Common in technology or growth industries, investors benefit from rising share prices, flexible instruments for hybrid financing needs, reduce issues, interest rates, payment burden after conversion, appeal lies in capital gain prospects. Debenture holders often become long term shareholders. Fourth is non convertible debentures remain debt instruments throughout tenure, fixed interest income for investors, no equity conversion, post maturity offer predictable income for portfolios widely preferred for retirement planning, attract conversions income focus investors, interest rates higher than fixed deposits, maturity ranges from short to long, suitable for steady cash flow needs. Example, infrastructure company and CD programs issued under rigorous regulatory frameworks secondary allow secured or unsecured structures, flexibility subject to statutory withholding tax provisions, liquid instruments in secondary bond markets, ratings determine their investment attractiveness, transparent processes ensure investor protection, plays crucial role in financial diversification, common in fixed income investment strategies, debt-based taxation, benefits during tenure, popular among institutional investor categories, key case laws, ITC Limited versus Debenture Trustee Company, established trustee responsibility principles highlighted transparency in collateral management, defined trustees' fiduciary duty scope, reinforced trust deed importance, significantly obligated trustees towards investor protections, provided clarity on trustee obligations, balanced issuer and investor legal rights case, strengthened legal enforcement mechanisms, increased issuer transparency during defaults, investors benefited through clearer legal frameworks, fiduciary negligence liabilities addressed comprehensively, significant for debenture backed financial products, landmark case, strengthened secondary market investor confidence, ensured fairness and conflict, redefined trustee role, transparency, and enhanced debt. Example of court driven financial responsibility case built precedents benefiting retail investors. ITC case, modernized trustee accountability expectations, National Textile Corporation versus trustee case 2001. Case involved liquidation versus debt priority, defined rights, strengthened security, and highlighted significance of collateral registration, addressed statutory procedural court-sided favoring secure debentures, protected investor assets, helped minimizing debt recovery, strengthened trust in corporate bonds, emphasize issuer transparency, liquidating hierarchy, reinforced created guidelines for financial documentation, enhanced legal clarity, benefited from improved procedural frameworks, case law emphasized asset backed securities reliability, debenture holders' rights, set benchmarks, safeguarding strengthened secured debts, highlighted need regulatory compliance, improved insolvency related investor financial predictability. Conclusion, debentures vital for corporate financing, offer diverse risk return investment options, ensure legal compliance, regulatory transparency, attractive instruments for structured portfolios, safeguard stakeholders via legal mechanisms, promote balanced corporate capital structuring, convertible types, attract hybrid investment models, secured instruments, provide liquidation safety guarantees, unsecured cater risk seeking market participants, strengthen financial markets, promote long term institutional market, transparent debentures practice, enable company sustainability, legal framework crucial, strong precedents, regulatory oversight, case law involves strengthening debt security, diversity, flexibility, transparent corporate structures. Conclusion: investments highlight the responsibility, balancing growth, insurance expansion, revenue strength, structured arrangements orderly.